Question 27. Vaultec Corporation, a U.S. company located in Charlotte, North Carolina, has the following import-export transactions denominated in Mexican pesos in 2017. March 1st, bought inventory costing 100,000 peso on credit. May 1st, sold 60% of the inventory for 80,000 pesos on credit. August 1st, collected 70,000 pesos from customers. September 1st, paid 60,000 pesos to suppliers. Currency exchange rate for 1 peso for 2017 are as follows. March 1st, 1 peso was 10 cents. May 1st, 1 peso was 12 cents. August 1st, 13 cents. September 1st, 14 cents. December 31st, 15 cents. It looks like the peso's value is increasing gradually. For each of the following accounts, how much will Vaultec report on its 2017 financial statements? That means what's going to be the ending balance on December 31st in US dollars of those accounts. Okay, so before we get to the solutions directly, let's prepare the journal entries related to those transactions on those 4 days. Okay, on March the 1st, that's the day the US company bought inventory costing them 100,000 peso on credit. So journal entry for this transaction is to debit inventory and credit accounts payable, and the amount we will record on the book is always in US dollars. And so on that date, because 1 peso was 10 cents, so we use this exchange rate and times the total peso that the company owed their suppliers and equal to 10,000. So this is the first journal entry on March the 1st. So because we need to figure out the annual balance for those accounts, so we can prepare T account for each of them. And the first one would be we can prepare T account for inventory for this transaction. So for inventory, we're going to have 10,000. This is more for 10,000. Okay, so all the amount here are in US dollars, and also we have accounts payable. Also 10,000. Then on May 1st, they sold 60% of inventory for 80,000 pesos on credit. So they sold inventory out. That's 60%. So 60% of their inventory for 80,000 peso. Okay, so let's prepare the sales first. So for the 80,000 pesos on May the 1st, we use 80,000 peso and times the exchange rate on that date. So on May the 1st, the exchange rate is 1 peso for 12 cents. So it's increased. And in total, that was 9,600 US dollars. So that's what we use for the account. So that's the amount we use for the journal entry. We debit accounts receivable 9,600 and credit sales 9,600. So next, let's prepare another 2 account here. 2 T account here. Okay, sales. Alright, so then let's move on. Still we need one more journal entry on that date for the sales. So for those inventory sales, the first is to recognize the sales. Second one is to recognize the cost of goods sold, because they have inventory sold out. And because they sold 60% of their inventory. So 60% of their inventory is going to be $6,000, because remember here, we have inventory balance 10,000. So that's why 6,000 times 10,000 US dollars. And okay, so here in this journal entry, we are going to have a new account, which is cost of goods sold. For cost of goods sold, we debit 6,000. At the same time, we credit 6,000 from inventory. Alright, so then let's move on to August the 1st. On August 1st, they collect 70,000 peso from customer. So they collect accounts receivable from customer, and journal entry is okay. So first is we first kind of need to how much they collected. They collect 70,000. So they collect 70,000 from customer, and next thing is we need to figure out what's the exchange rate change during this period. It changed from 10 cents per peso to 13 cents per peso, which means that for 1 peso, their customer owed them, now it's increased by 3 cents. So it's like have a foreign investment, and because of the foreign currency's value increase, then the asset increase at the same time, and the increase amount equals to the total amount of the asset. So 70,000 is the amount that the customer paid them, and then this, oh sorry about that, it's not on the, because the sales happened on May the 1st, so we need to compare May the 1st exchange rate with August 1st. So that's the increase of 1 cent. The increase only 1 cent. So the total foreign exchange gain is 70,000 peso times 1 cent per peso equal to 700. So in this journal entry, we debit accounts receivable 700. Okay, so debit 700. And then okay, so that's the first, to recognize how much value it increased. And second journal entry is to debit the cash and credit accounts receivable. This is the amount they receive from their customers, and the amount they received is based on the total amount the customer paid with peso and times the foreign exchange rate on that date, and total that is 19,100. So we credit 19,100. And first journal entry is to recognize this gain because of this increase of peso's value. Okay, so then let's move on to do I have any other transactions? October the 1st. Okay, so next journal entry is the journal entry on September the 1st. So this is the day when they actually pay their suppliers. And because of this change in peso's value, and in total they paid how much pesos? They paid 60,000 pesos to the suppliers. And because of this foreign exchange rate increase, so then it's going to be a loss for them to owe their customer in foreign currency. It equals to the total amount they owe them and times the increase of the foreign currency rate. Okay, so in this transaction, we need to debit a loss and credit accounts receivable by $2,400 US. Okay, that is 2,400. And then the second journal entry to recognize the payment of the total amount of this 60,000 peso they paid in foreign currency, and it was $8,400. That equal to the 6,000 peso and times the exchange rate on that date. 8,400. Credit 8,400. Okay, so let's move on to the end of the year, December 31st. Because of the exchange rate is keep increasing, and also because the company do still have some accounts receivable and accounts payable on their balance, so which means that's going to impact their current book value if we reevaluate their amount in foreign currency. So for accounts receivables, right now they still have 80,000 minus 70,000 available to collect. So this is like the remaining balance of on their book, the customer still owe them 10,000, and then we need to figure out how much what's the exchange rate increase during that period. That's going to be the year-end exchange 15 cents per peso and minus the transaction date exchange rate, that's 12 cents per peso, so the change is 3 cents. So in total for this 10,000 uncollected payment, it have a foreign exchange gain of 300. Okay, so we need to debit accounts receivable of 300 here. And next one is for the outstanding accounts payables, and then that's going to be a loss, and it equals to the outstanding accounts payable and times the exchange rate. Now it's going to be the December 31st rate with its actual original rate, and the total loss is 2,000. So we need to debit foreign exchange loss 2,000 and credit accounts payable 2,000. Alright, so then we can get the ending balance for each of them. For inventory, the ending balance is 4,000. For accounts payable, it's going to be 6,000. And for accounts receivable, it's going to be 1,500. And for sales, it's 9,600. And cost of goods sold is 6,000. Do we have any? Okay, we still have one more to calculate the cash. For cash, we need to figure out how much cash they collected and how much cash they paid. And then we know that on October 1st, they collect cash of 9,100. And then on September the 1st, they paid 8,400. Assume that they don't have any beginning balance of cash, so the ending balance of cash will be 700.